Regulating retail algo trading. SEBI is coming with a new regulatory framework requirement and how it can affect a retail trader. So let's start with a little history. The first time this news surfaced back in last months of 2016. Then by the end of 2017, there has been news floating around that SEBI is framing algo trading rules for retail investors. Even with brokers, they were cautious while releasing algo trading opportunity to their clients. But retail investors got access to algo trading when API access was opened. This led to rise of a few notable white label trade execution apps and systems. But now with the latest consulting paper published by SEBI aims to put a full stop to these unregulated layer participants. This can have far-reaching impacts on fintech companies. For some, this may send them to the obsolete course. The paper published by SEBI on December 9, 2021, object focuses getting views and comments from all the stakeholders in the market. In a name form, algo trading can be defined as a trade done by a system based on a given set of rules or a criteria. This helps the trader to stay away from the screen. Still, his trades get executed if the criteria given is met. So now, coming back to the current situation, in India currently there is brokers and laggard third-party clients which offer algo trading. Brokers often offers these services to premium clients, though they can be set to HNI retail clients. But API access have opened opened by the brokers have given rise to many third-party apps or systems which helps to retail traders to test and deploy their set of satisfied strategies. So these apps works on a user-friendly front end created by the service provider. Broker can know which orders are coming from this API, but currently the brokers have no system that helps them to differentiate whether it was executed with an algo or a non-algo. The set of algo trading offered by the broker have their permission and set guidelines to be followed by them. But these third-party algo trading venues doesn't come under the purview of current rules, and it is used heavily by the retail sector. The regulator is of the view, that means SEBI is of the view that this kind of unregulated or unapproved algo can be misused by these providers to lure retail investors by offering guaranteed returns. The regulator is also reported to view that this kind of unregulated algo can manipulate market on a large scale, like spoof orders and all. So coming regulation is to the upcoming regulation is to regulate this unregulated play field, which is mostly going to hurt these fintech companies and retail traders who have been previously enjoying the benefits. So what is the upcoming regulation? The regulation goes like this: brokers should tag all API orders with an algo ID provided by the exchange. Brokers need to get all and each algo certified by a DISA auditor or CISA auditor. Exchange now have to ensure only those algos traded with a unique algo ID to be deployed. Brokers also need to ensure that no alterations are done to the previously approved algos. All algos now need to run from the broker server even if it is deployed by third parties, and this means the responsibility of the order and confirmation and margin info is always with the broker. Broker can provide in-house algo strategies developed by an approved vendor or get it from a third-party algo provider with a formal agreement on the table. Third parties will be limited in use of broker's name in the testimonials with ad guidelines of exchange. Now, the broker will be redressal and dispute point if the algos go south. Two-factor identification for API access to an investor for any API algo trade will be there. The software used to create the strategy now also have to be approved by the exchange. There will be an additional audit requirement of algo trading checks in annual audit report submitted to the exchange as well. So as of now, the regulator is not after the third-party algo provider, but reading in between the lines, we can clearly see a regulation is aimed at them is also coming. bringing them under the purview of investment advisor or research analyst. Initially, this will be limited to taking some clarifications, declarations from the clients on the grounds on how he takes the service from the third party service provider. The regulatory is taking public comments. Actually, they took the public comments till January 15, 2022. We can now expect there will be a form of regulatory framework to be implemented in any part of 2022, thus bringing a new equation to trading. On a personal note, I think this can seriously change Bank Nifty and Nifty weekly option trading. I was one of the early adopters of the weekly option when Bank Nifty was introduced in 2016. And I have seen Bank Nifty weekly option trading change drastically over the years. One of the main reasons for such surge could be easy deployment of strategies by retail traders. The scale up was huge, and now this will come under the regulation. Hence, we need to see which all fintech white label will survive, which won't. Yeah, that's all for now. We'll get back to you with another update.